All right, guys, I'm doing my top 10 stocks series, and I'm going to look at the TVIX, even though that's not a stock and it's not in my top 10. Um, it it is a top thing that everyone's mentioning right now. And also, I did a VIX episode just a day or two ago, and just talking about volatility and looking at the stock market. But when I did the VIX, everyone's like TVIX this, TVIX that, TVIX is awesome, long the TVIX. Okay, let's take a look at this thing. This is a 2x levered ETN, and there's several things to point out with a levered ETN like this one that people don't know functionally how they kind of work. This is Brian Lewis with MMT Investing, and things just changed. So here we go. Credit Suisse 2x. It's the Swiss TVIX. It's the schvixx. People call this the fear index because it's a look at volatility, which roughly tracks the sentiment of fear in the market, and it's levered. So, if the VIX gets to here, the TVIX will get to here, and you get bigger moves. So people think that it's exciting if you're going to go long on it. And that might be true in the short term, but there's a few risks to point out here. And then I have a trick idea at the end of the video that kind of counters some of those risks. Uh, So yeah, Credit Suisse always smashes that like button right now to help me out with the YouTube algorithm. So first of all, let's say the difference between an ETF, exchange traded fund, which has actual assets inside of it that are backed, versus an ETN, which is an exchange traded note, which is just an unsecured debt note from a company like Credit Suisse that has nothing backing it. That's one risk, first off. And you have the contango situation as a second risk that we noticed. We saw, this crash. The USO, the oil ETF, went negative. The oil contracts went into contango, and that is when, even if it's a fund with underlying assets, the way that futures are built into ETFs and ETNs, when you get a current price that's lower than the future price, you get a contango situation. And when these contracts are coming to close, you're upside down and you have to get rid of the thing basically at any price before it expires. And for instance, with the USO, the oil ETF, those oil contracts that people were holding required physical delivery of barrels of oil. So the people that were speculating on those contracts just got stuck. Like, I have to get rid of this thing right now. And we saw oil go to minus 40 yeah, this was like a week ago that happened. The oil and the actual oil price of a barrel didn't go to minus 40, but the contango price went to minus 40 relative to the futures inside of these kind of ETFs. So that's a risk. You can get contango, and that's basically a long squeeze. So if you're holding these things long, you can get a contango long squeeze. Um, just that just happened. That's a real thing that happens. And and the price of the ETF itself can actually be significantly lower than the underlying assets. Like, the oil was not minus, but the ETF, the ETNs and the ETFs, whatever, the ETFs were negative. So that's contango. That's an unsecured debt note. And then we have uh, the levered compounding math. I guess is a really big one. It's a big one because the long-term future outlook of an ETN goes to zero when you do the levered compounding math. So say like the volatility index, the VIX, goes from wherever, say like 100 to like 110, and then it goes back to 100. So in the VIX, if you go from 100 to 110 to 100, you're at 100. On the TVIX, if you go from 100 to 110 to 100, it's 2x. So you go from 100 to 120, but you don't go to 100 on the way back. You actually go closer to like 98. And this is the compounding math. And you lose in the volatility, you lose a percentage. So when you're in very boring bull market conditions like we had in the last 10 years, you don't lose a lot on this compounding. But when you're in highly volatile markets and you're moving up and down a lot, you continually keep losing percentages here as you're holding this thing long. So the longer term you hold it, the more money you're going to lose. And mathematically, eventually, this thing goes to zero. So that is the compounding risk of a levered fund or a levered ETN. And if you go long on it, so that is why I keep telling my friends and family that keep mentioning levered funds to not go long on them and not hold them. Like maybe, if you just go long real short here and you sell it, that's okay. But what if you screw up and you're waiting for it to go long and you get volatility and you're like, yeah, sure, it's going to go, it's going to go up soon. And you just get volatility and sideways action. You're losing money and losing money this whole time waiting for it to go up. And then by the time it goes up, you've lost money. Even if it went sideways, you're just losing money on holding the thing. Um, so that is a big risk with the levered, and this one's only 2x, but the more levered ones have even more of this problem. And so that is a look at the TVIX and why I don't think it's so awesome to go long the TVIX when it looks like a long on the VIX. Even though it might be a good short-term move, and you will get a bigger return because it is 2x. There's just a bunch of risks that you have to pay attention to when you do something like that. So that's a look at the TVIX, and I guess I don't remember. Did I say hit the like button? Please hit the like button. And this is not trading advice. I don't know if there's anything else to point out here. I mean, I guess just the technicals of this look very much the same as the VIX, and they look very much the opposite of the stock market. So people think that the TVIX is kind of a short fund. Yeah, this was this whole surprise thing that I was going to talk about. I almost forgot to do it. Um, so we get this kind of situation where it looks like we're going to get a bull flag, kind of pin it, breakout kind of thing to the upside here, and yeah, so you would want to go long this thing, right? If it's going to break out hypothetically to the upside, that would be a long move. But the thing is, when you go long on an ETN, you lose all these percentages. So the trick that I was thinking about is instead of going long this, you just short the opposite one, and then those losses actually are helping you. You have to short it. So I don't know if there's an inverse TVIX, but most of the levered long funds, there's an inverse levered fund. So you should only short any of them. But if you want to go long, you short the inverse one. So I don't know if there's an inverse TVIX, but most of the funds have an inverse. And so instead of ever going long, you just pick which one you want to short. And then I guess you could sort of short both of them and just collect these percentages, but then you're I don't think that would work because this amount isn't big enough to cover the expense of doing it. But yeah, okay. So just in general with levered funds, like never go long, just short them. And if you do want to go long, you short the inverse one, and that is a long exposure without losing the compounding percentages. All right, we got through it. Talked about the risks and the levered stuff, and I think that'll do it. It does look like it does look like it does look like this is going to increase now. Also, the MACD on the S&P is indicating that this is going to start going up as well. And and also the trading movements now, we just got a huge rip down and a huge rip up. So those are big, more volatile movements, and that volatility is gonna look like it'll increase the volatility indexes. And okay, I think that's good enough. Careful with your ETNs and your contangos and your compounding math and your long exposure, and happy trading.